proactive planning for the next handful of years. It's exciting times, but don't ignore that there's no free lunch with the IRS.
Welcome to the Doctor's Eyes Only podcast, brought to you by Vestia Personal Wealth Advisors, where we are on a mission to help the highest caliber physicians achieve wealth that matters. Hello, everyone. Welcome to another episode of the Doctor's Eyes Only podcast. I'm Lauren Oschman, and I am here today with co-host Kameron Helmuth. He is one of my partners here at Vestia. Also, longtime listeners of the show might remember when Kameron was a regular co-host. So it's fun to have him back. I always like recording with Kameron. We are going to be talking about the changes to the tax code in the recently passed One Big Beautiful Bill Act and things that physicians should have top of mind as they're thinking about tax planning, both to finish out 2025 and then particularly in 2026 and beyond. So welcome, Kameron. So glad to have you.
It's great to be back. It's been a while.
I know it has. It's always fun because I feel like we don't skip a beat. It's very easy to talk. I mean, we talk taxes not on recording, so it's very easy to jump in and talk taxes for the audience.
Yes. And this has obviously been the talk of all the changes that are going on. This is the one that people are most interested in. And it's interesting because it's got a lot of changes and then very few changes in the same way. So very intriguing.
Yeah, totally agreed. I know as I've been talking with a lot of physician clients, I've kind of said much ado about nothing. And that's making a little bit light of it because it's not nothing, but it's just the changes, especially on the personal side. I know we'll talk a little bit about personal and a little bit about business for practice owners, but especially on the personal side, a lot of small changes that for most of the doctors that we're working with really amount to no major impact to them.
Yeah. There's so many of the changes that came through still have phase outs, still have income limitations that just don't apply to our clients. But I still think there are some important ones, more so of planning tactics we originally were talking about. Hey, 2026, a lot of changes. Let's start planning now. We thought they were going to happen, and a lot of them are not happening the same way, or they've been extended indefinitely, which actually makes planning in some ways easier. But I still think there's some strategic things that people should be considering given the changes.
Yeah, for sure. So let's kind of start there because you're exactly right. We were expecting, because when the Tax Cuts and Jobs Act was passed back in 2017 during the first Trump administration, that's the tax code that we were under until this One Big Beautiful Bill Act passed. So all of the tax changes that were in that Tax Cuts and Jobs Act were expected to expire at the end of 2025. So we had an election cycle in between there. We had another administration. So we have kind of been planning this whole time thinking that, and first and foremost, the top tax bracket was eliminated for the last few years and was set to come back in 2026. What we saw in the One Big Beautiful Bill Act is that top tax rate has been eliminated, I'll say indefinitely. So you will hear people using the term,
loosely used indefinitely, but yes.
Yes. You'll hear people using the term permanent. I think this is an important distinction. They'll say it's permanently eliminated. Yeah. Nothing's permanent when it comes to the government because any new Congress can come in and pass their own next chapter. So we'll say it's been indefinitely eliminated, which is great. That means there are a lot of doctors who are making high incomes that would have bumped back into that 39.6% bracket. They will stay in the 37% range, which obviously will take what we can get.
That's right. Everything we can get. I think a couple of the other big things I know that I've been talking to clients about for a few years, income tax brackets are one of them. Clients are always interested in itemized deductions, right? We have most of our physician clients that are itemizing versus that standard deduction. And even the standard deduction was originally talked about being drawn back or wound down, and that's staying and actually increasing slightly. So that's good if you do use a standard deduction. That's actually simpler, and you're getting a little bit better benefit for that. But a few of the itemized deductions that I do feel like need to be addressed would be the SALT adjustments as well as the charitable giving contributions. Those are probably the two big ones that we should address.
I do want to just standard versus itemized deduction. So if you are listening and you have a mortgage, especially a sizable mortgage, which most doctors do, then you are very likely itemizing your deductions because mortgage interest is a piece of that. So you can pay attention to what we're talking about in itemizing if you fit that category. The standard deduction is just the coupon that they give everyone for tax deductions. And again, that Tax Cuts and Jobs Act made that a lot larger than it previously had been. So really, these categories that we're talking about in itemized deduction, so your state and local taxes, which are currently capped at $10,000, that's this SALT that Kameron's going to be talking about, plus your mortgage interest, plus your charitable giving. If those three things total more than $20,000 a year, then you are probably taking the itemized deductions versus taking the standard deduction. So just to kind of orient everyone there. Now let's go into that itemized deduction. So mortgage interest, tax deduction is still there, not going away. You can only do it if you got a mortgage more recently on $750,000 of mortgage interest, but that's still there, hasn't gone away. The SALT taxes, so that stands for state and local taxes, used to be you could take all of your state taxes, all your local taxes, that was all a federal deduction. Again, that 2017 tax bill capped it at $10,000, which cut tax deductions for a lot of doctors. So tell us, what did this One Big Beautiful Bill Act do to the SALT tax deduction?
This is a great example of it changed a lot and a little at the same time for our clients, at least. So if you think of $10,000, especially if you're living on one of the coasts or a prominent area where you do have larger local taxes and you've got a state income tax, it's pretty quick that you get to that $10,000 limit. So there were a lot of people that were losing that additional benefit or the additional write-off. What this has done is it's actually increased the maximum that you can take all the way up to $40,000, which is a significant amount. However,
Don't get excited.
Don't get excited. There's an income phase out. So like most of our clients, as you get closer to the number, it's around $500,000, a little bit under, but as you get closer to that income limit, that starts to phase down. So the reality is most of our clients won't see a big impact to that SALT limit, the state and local tax limit for itemized deductions. However, if you are in a state or in an income situation where you've got some control, so I'll give you an example. If you do some moonlighting or if you do some locums work and maybe you don't do some of that this year or you bunch that into one year versus another, maybe you can do something strategic to get under that state and local tax limit to maximize that for itemized deductions. It's a small strategy. It could pay off. But again, for most of our clients, it's pretty uneventful, unfortunately, but it is nice to see some additional benefit for other clients that could benefit in the right income tax brackets.
Yeah. And I know I'm in Tennessee where we do not have state income tax. So this is not near the topic of conversation here that it is in other states like Indiana. We have a lot of clients in California, but definitely talk to your accountant, talk to your financial advisor, see if there is any strategy that you can use to even get a bigger deduction one year and then a lower deduction the next year or something like that. Speaking of, so charitable giving is another place that's in that itemized deduction category. We've seen some change, some of it beneficial, some of it less beneficial in the realm of charitable giving. So talk to us about that. So there is a charitable giving change for those who don't itemize. If you take the standard deduction, previously you were not able to take any deductions for your charitable gifts. They introduced the ability to do that to a limit, right?
That's right. So if you do take the standard deduction now, there is a very small benefit that you get for charitable deductions, which is huge. I mean, again, and if you think back to that itemized benefit, a lot of people are trying to maximize, but there are other people who are doing normal gifting and it's just not as beneficial to them. So there's something there for those people now. But on the flip side,
it's $1,000. I'll just chime in. So those who are listening, it's $1,000 if you're single, $2,000 if you're married filing jointly. So effectively, you can think about that since this is a deduction, it knocks off whatever your effective tax rate is from that amount. So if you're married filing jointly, you give $2,000 to charity, 35, 37, whatever tax bracket you're in, of that will come back to you in tax benefit. And again, previously you weren't able to do that. So if you take the standard deduction, be mindful of cataloging the charitable giving that you're doing because you can get some tax benefit. Now, talk to us about how it's changing for those who itemize, because we're actually taking a little step back there.
Yeah, unfortunately, a small step, but it is a step back. So again, if you were itemizing prior, whenever you were doing a charitable contribution, you were able to deduct every dollar from the first dollar that you were gifting. They've now put a limit on that you're only able to deduct anything over 0.5% of your income. So if you're making $500,000 a year, for example, the first $2,500 of your gifting, you can actually no longer deduct. So again, it's not a huge trade-off, but it is something to be cognizant of. I think where people really need to be intentional is if you're in between. So I'll give you an example is I've seen clients that the only write-off that they have is charitable contributions. So here's the problem. If you're gifting $10,000 a year, you can't itemize, yet you're only getting a small benefit on your standard deduction. That might make sense to talk about strategies of bunching those gifts or maybe doing a larger sum in a certain tax year so that you can get to that itemized deduction. But understand that if you're doing normal, smaller contributions, there's something for you. But if you're doing larger, there's going to be a little bit of a hit, but not anything too substantial. Just something to keep in mind.
Yeah, that floor definitely. And the vehicle that you could be thinking about if you're going to ask your advisor, ask your accountant, would be a donor advised fund. So a donor advised fund would allow you to take multiple years of gifts that you plan to make to charity. You can put them all in the donor advised fund in the same year. So in Kameron's example of $10,000, maybe that you gift annually, if you said, well, I'm not going to get the maximum benefit or any benefit if I just give $10,000 a year, but if I give 20 in 1 year, then I will realize a tax benefit on a good portion of that. You could put 20,000 in 1 year into a donor advised fund, and then you get the tax deduction in that year of the contribution, and then you can direct those funds to charity at any point in the future. So that can be a good vehicle to consider if you're in that position where you are doing a good amount of charitable giving and maybe you want to be able to maximize the tax benefits in this kind of new tax environment. The other thing to be mindful of is that if you're in the 37% tax bracket, these itemized deductions, they're only going to give you a 35% deduction for starting in 2026. So that's another piece to think about. If the bulk of your itemized deduction benefit is coming from charitable giving, starting in 2026, you're both going to have that floor of 0.5% of your income, and then you're also going to be capped at 35% for your deduction. So this is a place, again, you can talk with your accountant, you can run some rough numbers, and you can decide if maybe a donor advised fund would make sense before the end of 2025 to maybe help maximize some of the deductions for the next couple years, next few years of charitable giving.
We built our firm around one goal, helping physicians achieve wealth that matters. Time with your family, freedom in your schedule, and confidence in your decisions. Not sure how you're doing today? Head to vestiaadvisors.com/DEO, that's DEO for Doctor's Eyes Only, to take our 3-minute Physician Wealth Checkup and get a snapshot of where you stand today and what to do next.
I think that's extremely impactful, especially if you're somebody who's anticipating an income drop. I'll give you an example of a physician recently that is in the final years of a buyout in a private practice, and next year there's going to be a substantial drop in their income. They are charitably inclined. So we actually took advantage of this year's higher income tax bracket, this year's higher ability to write off those itemized deductions, leverage that donor advised fund strategy, didn't have to make all the decisions around where the money's going. We just made the decision around how we optimized. And a little spoiler alert, we used some appreciated investments and some stocks that actually gave us additional benefit instead of having to pay taxes in the future when you sell those. So there's a couple of different ways to leverage it. But yeah, if you're especially charitably inclined, I think discussing, also we'll talk about it here in a minute, but with the change in estate tax limits, some of those gifting strategies don't have to be so closely guarded because you have a very large amount of a lifetime gift that you can give now. So you can be a little bit more aggressive with that gifting if you choose to.
Yeah, that's great. And we should talk a little bit about that estate tax exemption as well, because I know that was something else that we thought could change meaningfully going into 2026. And what we saw was actually very beneficial for a lot of the doctors we're helping plan. The one other note that I'll add just about individual taxes, because I know we have some physicians that use this strategy. If you use college savings accounts, so 529 plans, I guess education savings, I'll say, pre-college for K through 12 education, you have over the last few years, you've been limited to $10,000 per year that you can take out for pre-college, so K through 12 private tuition. They have expanded this opportunity as well in this new tax bill. So starting in 2026, you'll be able to access $20,000 per year for pre-college expenses. They've also added some things. I know I have a number of clients that have kids in high school that are trying to maybe get up their standardized testing scores or things like that for college admissions. And so they're paying for tutoring, they're paying for exam prep courses, things like that. Those expenses now also qualify to be for you to use 529 funds for. So I know that applies maybe to less of the listeners, but I still have used strategies of using overfunded 529s, or maybe taking a state tax deduction for 529 contribution and then pulling that money out for a private school tuition, things like that. So just be mindful of the fact that there's been an increase to the flexibility there with 529 plans as well.
Yep. It's a great point.
So if we talk about the estate tax exemption, again, good news, I would say, that we saw there. Talk to us about what the new estate tax landscape looks like.
Yeah. So just as a recap for listeners, the estate tax limit is something that everybody has individually, and it's essentially an amount that you can either pass on at the time of your death or throughout your life gift. And it's just basically a running total that throughout your life is being tracked. And once you exceed that amount, that's when the federal government will come in and actually tax your estate. So I think some people get a little confused by, I don't want to hit my assets that are passing on to my heirs with the state tax. It's a fairly high number. Today it sits at $14 million. Now the reason this year had been
not per couple, per person.
That's right. And the reason it had been such a hot topic this year is because it was originally set to be cut in half next year. And so we were looking at our clients, and remember, when you think about your estate, we're talking assets, we're talking real estate, we're talking your life insurance, death proceeds, we're talking everything that you can imagine. So that number can grow very, very quickly. So we had been discussing, what are some strategies to potentially shield some of these assets from estate tax? Do we need to remove them from your taxable estate? And we can talk about that in a second. But good news is in 2026, that sunset has gone away and will actually be increasing slightly to $15 million per person. And it will continue to increase with cost of inflation. So I think of it as less indefinitely, loosely. I think of it as less of a fire drill, but there's still a few things I think are important to consider. Remember cost of inflation. If you have, let's say, for example, assets in your portfolio or in your net worth that potentially still appreciate faster than what that cost of living adjustment would be, there could still be a conversation around, do we need to get these assets removed from our taxable estate? An example would be, if you have a vacation property in a prominent area and it's appreciating at 10% a year or 15%, which is not unlike West Coast, East Coast ski locations, does it make sense to potentially remove that so that I avoid the issue in the future? Because remember, if you have an asset today that you take and then move into a trust or some other entity, it still is in your estate for the next 3 years. So it's not like an overnight thing that you can say, well, in the future, if something happens, I'll do it then. So be proactive still in considering some of those nuances. The other one would be life insurance. That's usually the two that are surprises to people. And if you have some large life insurance policies with big death benefits, a consideration of holding that in something called an irrevocable life insurance trust. And does that make sense to have it removed from your estate? It's not right for everybody. But again, if you have a reasonable net worth that's teetering on the edge of that estate tax limit today, consider that for future-proof planning.
Yeah, no, I think that's a great point. And again, applies to a much lower percentage of physicians now that we've seen this 15 million in 2026, and then it will index with inflation going forward, than if it had cut back to 7 million as it was set to. Because in that case, I mean, even a $5 million life insurance policy, which a lot of younger physicians with family obligations and debt and all of that will carry, you add not very much on top with home equity, investments, that sort of thing, and all of a sudden you have a taxable estate. So less of an issue than we thought it was going to be, but very glad to see that was expanded.
Yep, 100% agree.
Perfect. Now let's transition because that was the personal stuff. And I mean, like I kind of joked in the beginning, much ado about nothing, very small changes, not a lot that you need to proactively do. To be honest, that top tax rate is going away regardless of whether you do anything or not. The SALT limitation, that formula is going to apply to you whether you do anything or not. So the charitable giving that we talked about, that's something to talk to your accountant about, maybe that SALT deduction. But other than that, not a ton that you need to proactively be thinking about doing. The story is a little bit different on the business side. We actually saw, as probably was expected, some nice new opportunities for business owners. So give us maybe the highlights. What are the things that business owners, medical practice owners are excited about in this new One Big Beautiful Bill?
Much like a personal changes were much to do about nothing, this on the business side is all the rage. This is everything that everyone's talking about if you're a practice owner as a business owner. A few of the big things that happened. Again, this bill on the business side is really intended with the primary goal of we're trying to fuel expansion. We're trying to fuel business growth. And so with that comes the conversation around depreciation and this concept of bonus depreciation. And so as a reminder, when initially tax cuts happened, there was an issue of new bonus depreciation, which again, depreciation means if you purchase an asset today, we're going to assume that over the lifetime of that asset that you're going to be able to basically get less and less use out of it, or the value starts to decrease because you have to put renovations into it or you have to upkeep, whatever the case would be. But your usable value goes down over time. That's depreciation.
And the IRS gives a lifespan to different types of assets. So it's not like you're making that up fresh. The IRS gives you some guidance there.
And that's what I was going to mention, because if you're a private practice physician and you bought a new location, that commercial property is going to have a fairly long, 27 plus years that you're going to be able to depreciate that. Now, in the past, tax cuts said, you know what? If you go buy this piece of property today, we actually will let you take the entire purchase amount as a depreciation in the first year you put it in use. It was crazy. The amount of business development, the amount of investments, right, wrong, or indifferent that was happening, it was pretty astonishing, because remember that depreciation will help offset your earned income inside of that private practice. Now, over the past few years, that amount, which was originally 100%, has gone down slightly. This year was originally set at 40%. That is back to 100% bonus depreciation, which is a big deal. So there are a lot of physicians, private practice business owners who have been thinking about the expansion or considering it. And to be fair, it's been more stringent because our interest rates aren't good. People aren't out there just, happily taking out a business loan at 7 or 7.5% to go and expand their business unless it makes
right. You're looking at the numbers a lot more closely.
That's right.
For sure.
So this is helping fuel that. So now again, post January of this year, if you were to purchase and put a piece of property or certain equipment into use in your business, you can take that 100% bonus depreciation in year one. If you don't want to do that, you can still accelerate depreciation. And we could talk about that in another episode actually coming up, that we're going to talk about what is a cost segregation study and how do you accelerate depreciation. There's
that deserves its whole own episode given how detailed it is.
It does. And at the very high level, it just says, you know what? If originally I could take my entire purchase over 27 plus years, aren't there certain things in my building that fall apart or depreciate faster than the infrastructure of my building? And the answer is yes. So there are ways that you can allocate and say, you know what? This thing and this thing actually depreciate faster. So I'm going to take that over the next 5 years instead of 27 years. So there's a big conversation that needs to happen right now with your CPA and your planner if you're looking at an expansion or you've just bought a building, or if you already have a building and you're trying to evaluate, does any of this make sense for me? Because if you're like a lot of business owners, you're always trying to maximize the bottom line. If you've been considering the expansion, but you've not had the incentive to do so, this could be it. The other big one that I feel like needs to be addressed would be if you're ever in or heard of research and development, that has been a big topic of conversation in the past. You'd have to be a very specific medical group. You'd have to be a practice that's doing clinical research. You'd have to be self-funding certain research, but that does apply to a lot of groups out there. There are specific tax credits just for that activity and the cost that goes into it that you could leverage. But for the past 2 years, it's kind of been in limbo. And you can take it, you can't take it. And it's just been a real holding
been
pattern.
a little bit of a gray area. No one,
Yeah.
It depends on interpretation and who you're talking to, whether
Very
you
much
feel
so.
confident in that. Yeah.
That's right. So they are back. But here's what I will say it's a good thing that these tax credits are back. I think it's very exciting, especially as a business and a practice owner. Beware. This is also the time that you see new companies coming out of the woodworks left, right, and center and saying, I can help you with this study. I can help you with these credits. So please start with your CPA, start with the trusted advisor, and only work with reputable companies that are already doing this work. It is not worth the reward to put yourself at risk with subpar work or someone who doesn't back you in the case of an audit, because these are big, big tax savings that we're talking about. So just something to keep in mind.
Yes, such a great point. And starting with your CPA is huge. They will probably have a referral for you, someone that they've worked with in the past, or another client of theirs has worked in the past that's done good work. And that the case of an audit is huge, because the last time you want to find out that you worked with not the right partner is when the IRS is actually asking questions and they're nowhere to be found. So you want to make sure that you're choosing good. And it is important. And again, we're going to go into all of the details of that in a future episode. So stay tuned if this is something that's interesting to you. I will also say that time is of the essence if this is an opportunity that you want to be able to take advantage of in 2025, because that cost segregation study that Kameron's mentioning, if that is something that you need to do in order to be able to take advantage of the tax deductions the way that you need to or want to for your 2025 situation, the demand for those cost segregation studies is high right now. So you need to make sure that you're getting things into motion now so that you can actually get everything completed and get that deduction in 2025. That may not be as big of a deal for you if, there's not outsized income that you're wanting to offset in 2025, things like that. But just be mindful of the timeline and make sure that you get a quick start if that's something that you want to be a 2025 opportunity for you.
That's right. And I will add, as part of that tax planning conversation, don't ignore your future estimates in tax planning. So let's say Q4 comes around, you're going to owe a tax estimate in January. Don't ignore the fact that if you do something yet this year, you're not talking about, hey, when I file next year, you're talking, how am I impacting my cash flow today? So those things should impact and be reflecting in your next tax estimate, for example. So it is a very exciting opportunity, but you do need to be proactive and just be cognizant of, again, people are out there to take money, unfortunately, from physicians all day, every day. You need a reputable person to do this, and also be smart about how you're leveraging. If, it sounds super exciting to take all this bonus depreciation in year one, but you know what? If you're just starting out, or if you look at it, it might make sense to take it over a 5 or a 7 year period if that's the best thing for your business. The answer is not always push it into the current year. That's not the only strategy.
Future tax deduction and moving it into this year. So that's something, looking at kind of the lifetime projections and saying, because there are situations where that ongoing depreciation benefit might be more valuable and make more sense. So that's exactly what was on my mind, Kameron, as you were talking, is I think that's why the role of a financial advisor is so crucial when you're looking at making these decisions, because we're talking about balancing the personal and business pieces of the tax puzzle. We're also looking at what actually makes the most sense for your situation. And if you talk with a party that's looking at things in a silo, of course, your accountant is going to be looking at, well, how do we maximize tax deductions this year? Because they know that you're going to be really excited about that win. There are great accountants out there that are tax planners who will help you think about that bigger picture, but that's not every accountant. And so I do think having someone who you trust, who understands your goals for your family, for your business, and how all of that fits together, who can kind of give you an outside perspective and look at some of the proposals that you're getting and say, yeah, I think this makes a lot of sense for you. Or yes, I do think this makes sense to pursue. Or, oh, wait a minute, I think in your case, this alternate option might make more sense. And here's why, can be so valuable, because there is a lot of noise out there right now about these big, yes, especially kind of advanced accelerated tax deductions.
Yeah, I 100% agree. I will say one other strategy that at least should be mentioned is, so we talked about SALT just a little bit ago. If you are a business owner or a practice owner and your state allows it, I would definitely explore a conversation around pass-through entity tax. So as we talked about, it's great to have that increased limit, but because you likely still make too much money, you get phased out. A pass-through entity tax, all that allows you to do is, instead of what I would have normally paid for that state and local tax on my personal side and take the deduction on my personal side, it actually lets you take some of that and pay it instead through your business. Now you get a direct offset of your business income. You don't have the same limitations or restrictions, and that directly lowers your taxable income. So you don't lose out to that phase out or that cap on the personal side. So number one, not every state has it. Number two, there is some nuance that comes with it as far as how to apply. It's not the most easy to understand. And frankly, some CPAs don't even have their arms wrapped around it because it is fairly new still. So if you are a business owner, I would definitely explore that if it applies to your state and see if you could leverage that and have a more tax impactful situation. But yes, proactive planning for the next handful of years. It's exciting times, but don't ignore that there's no free lunch with the IRS. So you take all the benefits this year, you're still going to pay for it at some point. So you need to balance it with what your actual objectives are.
Yeah, I love that. I love you brought up the pass-through entity tax because that's a great opportunity to explore if you're in a state that allows for that, where you can essentially move that state tax to the business side. So
that's right. Yep.
All right. So we covered a lot. Hopefully this was helpful. We really tried to boil down to the things that are impacting physicians and the questions that we've heard physicians asking. So this is not all encompassing. This is not everything that's in that new tax bill. We do have some blog posts on our website, vestiaadvisors.com, that you can reference that does have more detail in it. Again, we always stay focused on what's relevant for physicians because that is our audience. But you can also reach out to your accountant. You can reach out to your financial advisor. You can reach out to us at Vestia if you don't have a great financial advisor, and we can help you understand how these things might impact you. Is there anything else, Kameron, in terms of parting thoughts or anything that we missed that you want to make sure that everyone hears about today?
I think we covered most of the highlights. Again, I think there's a lot of detail. I would just encourage you, don't get lost in the weeds because, again, so much of it does not apply to a physician life. What I would tell you is I have heard from many of our prospective clients and current clients that this tax change has been what's had them on the sidelines of doing other things, big financial decisions. And so now that we have some clarity, I would just encourage everyone to obviously be educated, make some decisions though, and understand that this is, at least for now, the foreseeable future, which is a sigh of relief in a lot of ways, just meaning less change to come. So you can now focus on the other parts of your financial planning and don't ignore that. But again, if you don't have an opportunity now, I would encourage you, get your CPA, your attorney, and your financial advisor in one room, and everyone get on the same page around how these tax laws apply to you and how you can leverage them. So you're all doing the same thing. I think that's one of the most impactful meetings you're going to be able to schedule in the next 6 months.
For sure. Yeah, totally agree. And if you've been listening this whole time and you're like, they didn't talk about student loans, that's because we covered it in our last episode. So I had Chris Robbins, who's another one of our Vestia advisors, who's really our resident expert on student loans. We talked about everything the One Big Beautiful Bill Act brought for student loans. We talked about what that means for the future of repayment and PSLF and all of that. So if you were tuned in for that reason, then you can hear that in our prior episode. And again, we have one coming up here shortly that will be all about those cost segregation studies and how to take advantage of bonus depreciation, not just with medical practices, but also with things like short-term rental properties, Airbnbs, things like that. So stay tuned if that's of interest for future episode. Thanks so much for being here, Kameron. I really appreciate your time.
Always fun.
Are you looking to hire a financial advisor with physician-specific expertise? At Vestia, we work exclusively with doctors, helping you navigate things like student loan repayment, reviewing RVU-based contracts, navigating practice buy-ins or private equity offers, optimizing retirement plans, designing tax-smart investment strategies, and planning for things like parental leave or early retirement. We have over 150 years of combined experience working with specialized physicians. So chances are, if you're thinking about it, we've helped another doctor through it. We built our firm around one goal: helping physicians achieve wealth that matters. Planning that's not just about numbers, but about designing the life you actually want to live. That means your wealth lets you live the life you imagined when you first started this journey. Time with your family, freedom in your schedule, and confidence in your decisions. Not sure how you're doing today? Head to vestiaadvisors.com/DEO, that's DEO for Doctor's Eyes Only, to take our 3-minute Physician Wealth Checkup and get a snapshot of where you stand today and what to do next. Thank you for listening to the Doctor's Eyes Only podcast. We hope today's conversation advanced your journey to wealth that matters. Please make sure to follow and subscribe so you don't miss a single one of our amazing episodes we have coming up. See you next time. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Vestia Advisors, LLC. The content has been made available for informational and educational purposes only. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax advisor. This information is not an offer or a solicitation to buy or sell securities. Investing involves risk, including risk of loss. Before investing, you should consider the investment objectives, risks, charges, and expenses associated with investment products. Investment decisions should be based on an individual's own goals, time horizon, and tolerance for risk. Past performance is no guarantee of future results. Diversification and asset allocation do not ensure a profit or guarantee against loss. Consult your financial professional before making any investments. Investment advisory services offered through Vestia Personal Wealth Advisors, Vestia Retirement Plan Consultants, and Vestia Advisors, LLC. Securities offered through Osdale Financial Partners, Inc., 5187 Utica Ridge Road, Davenport, Iowa, 52807. Member, FINRA, SIPC. Vestia Personal Wealth Advisors, Vestia Retirement Plan Consultants, Vestia Advisors, LLC, and Osdale Financial Partners, Inc. are independently owned and operated.